Dobrý den, posloucháte podcast, který se vám pravidelně snaží představovat renomované hosty na poutová témata ze světa financí a ekonomiky, tak, abyste se ráno budili v zelených číslech.
Greeting fellow listeners on Investors podcast, which is produced under the name of Investors Club. We are happy to welcome you to our first ever English podcast, and my name is Aleksandar, and my co-host is Jozef.
Hi, everybody.
And we are currently located in a vocal studio in the city of Brno in Czech Republic. Our today's guest is Michael Guide. Hi, Michael.
I appreciate the ability to do this across the globe.
Exactly.
Yeah, Michael is the co-author of 4 award-winning research papers on market anomalies and investing. Also, he is an active contributor to MarketWatch and has been interviewed on CNBC, Bloomberg, Fox Business, and as well as the Wall Street Journal Live for his unique approach to interpreting market movements. Michael, the floor is yours now. If you want to add anything that I didn't mention.
You did a better job than my mother at describing my credentials. So I appreciate that, guys. Listen, I've been around for a while, and some people like that, some people don't. But the one thing about me is that I'm not going anywhere.
That's how it should
be. Okay. Michael, so at first, what led you to portfolio management? Why did you choose the finance sector?
Yeah, it's interesting. I was never necessarily sort of, in quotes, nudged to finance, but I've brought this up before. I kind of grew up in the business. My father worked alongside a guy named Bob Farrell in the late 1980s at Merrill Lynch, who was this sort of legendary technician. I grew up, seeing him leave that position, starting his own investment advisory firm, launching a hedge fund. And seeing his own passion for markets. When I was 16, worked on the floor of the New York Stock Exchange, fell in love with the excitement of it back then. And I always found it just an interesting field and domain to focus on. I was one of those kids that would try to read as many textbooks and books as possible on investing markets, kind of the old school technical analysis tomes that nobody even knows exist anymore. So I think there was a degree of osmosis, just seeing my father have that passion, and then that kind of filtering through to me.
Okay, so would you say, because this was my another question, that you were highly influenced by your father, right?
Yeah, I think to some extent everybody is influenced by their parents, right? Makes sense. Aside from
totally
the genetic aspect of it, and obviously, even if it's not genetic, right? It's who you're around, right? Human beings are very good at mimicking other human beings, right? Which is why we get into these echo chambers. Why confirmation bias is a legitimate thing, because we kind of form our own thinking based on the thinking of others.
Totally. I really enjoy your thread with videos of your father that you published on 24 December. It was really good one thread, and I highly recommend everybody to watch through it.
Yeah, I appreciate that. It's funny because it's like on an old VHS, which I don't even know if people know what that is anymore, but it used to be how people would watch. Right? Other countries, I'm sure, still have VHS tapes. In the U.S., not so much, but yeah, it was a video that was literally just like in a closet. It was a VHS tape that was in a closet. And I saw, the title of it. I started playing it. I asked my mother what it was. She forgot that we even had it. And I was able to digitize that video. It's a nice memory. He was, he was asked in that video to basically teach the basics of technical analysis to a bunch of Merrill Lynch brokers, right? Because, it's something we can talk about. A large part of the investment industry, like it or not, is sales, right? And
totally,
in order to be able to sell, you have to be able to communicate, an idea, which means you have to still know how to analyze, right? So it was that sort of introduction to technical analysis, which, even though that video is from the mid 80s, it's funny how this stuff really doesn't change, right? The analysis, the way that people think about things, it's kind of frozen in time,
totally.
Which is why it's so remarkable.
Yes, I agree.
Okay, Michael, and moving on to your performance, how was your year or 2 years during this pandemic? And well, as a portfolio manager, was it chaotic? Yeah, and well, basically due to this whole new situation in the world.
Yeah, I mean, so my entire approach is predicated on leading indicators to volatility, right? Which is what risk off is. People think that risk off means no risk. It doesn't mean no risk. Risk off means conditions that favor higher volatility. Higher volatility translates into default risk. So a year like 2020 was actually phenomenal in my world, in the sense that I don't say that in a cavalier way. My mutual fund ATAX, which I launched in 2012, more risk on, risk off, as a concept, more complex than my ETFs. In 2020, my mutual fund was up 72%, not because it was in, these kind of nonsense, profitless tech companies, but because, and it's all documented, it was risk off in long duration treasuries prior to the COVID crash, consistent with the research that it gets ahead of high volatility tail events, and then went risk on March 31st. So, got sort of the avoidance of the big decline in stocks, treasuries making money, and then got back into stocks. And of course, there were a number of kind of false rotations along the way, but 2020 was the best year I ever had in my career, which, again, in the context of everything that happened, I feel bad saying, but that's kind of what I designed the approach to do, right? To thrive when everything's kind of collapsing. The thing is that only lasted for a year, right? As you know, 2021 comes along. I try to play risk on signals in small caps, which go nowhere all throughout 2021, emerging markets actually trending lower. And then last year was brutal in that as much as it was a bad year for stocks, it was a worse year for bonds and even a worse year for treasuries from a flight to safety interaction against stocks. So it's been a very humbling period, right? I launched my mutual fund the day before QE3 in 2012. There's not much risk post QE3 and zero interest rate policy, so I'm whipsawed around risk off with that mutual fund. Then I had my shiny object moment in 2020. And then 2 years later, in terms of at least the assets under management, I go round trip despite, kind of killing myself for a decade trying to preach about the importance of risk management in an environment that had no risk at that time.
Yeah. So I think like you said, the year 2022 really humbled us all. And I have another one question regarding this. Like, how would you describe overall the year 2022? What lessons could be learned, and what implication to the year 2023 are here for us?
So I think the biggest lesson you can learn from 2022 is that shit happens. And I'll tell you why I say that. Look, in any data set, in any strategy, in anything that you follow, you're going to have anomalies. You're going to have outliers. Okay, you're going to have something which you haven't seen in the data set. This is just the nature of life markets, right? So last year was the first time in history that long duration treasuries failed as the quote unquote flight to safety trade. Right, it just didn't counter equity volatility in a top 20 drawdown. I've shown that chart on Twitter many times. It's not my opinion. 10 out of 20 biggest declines for the stock market, peak to trough, treasuries making money. Long duration TLT is a proxy, that fund. In 9 out of 20 times, treasuries lost, but they lost a lot less, including in the 70s. Last year was the only time in history it lost more than stocks in a top 20 drawdown for stocks. Now, the lesson there is, okay, well, clearly you can argue that treasuries were due to fail against equities, and that's why you can't necessarily rely on the approach. Okay, maybe. But there's another lesson which we could be finding out in 2023, which is that all the lessons around 2022 are actually false. Okay, and what I mean by that is, yes, treasuries, the risk offside failed last year. That's why I had such a nasty drawdown in my own funds. The attribution is not really around stocks, it's around treasuries. So the signals were right to say defense. The execution, the opportunity set, is what failed. But what if the drawdown for stocks is not over? In other words, what if we haven't seen the lows? What if the bear market is still intact? Which, by the way, despite this melt-up dynamic I keep hammering on, is my belief, right? That we have not seen the lows. We had a duration crisis last year, and we probably have a credit crisis this year. Now, if I'm right on that, that means you break the lows, stocks, the drawdown becomes deeper, and maybe this time around in the next wave lower for stocks at some point, treasuries do what they do. They counter. They act as that flight to safety, what I was called the Phoenix Rising analogy on Twitter.
I saw it.
Right. So I say that because my point is that, if somebody's going to say the lesson of last year was that treasuries, are not always a safety trade, it assumes that the drawdown for stocks is over. If it's not over, then the only lesson you learn from 2022 is to be patient, because the flight to safety trade never went away, if I'm right in that sequence of returns.
Yeah, I was kind of similar, I followed many people. I was coming up with my own investment thesis, but I just didn't feel it in year 2022. It was so many anomalies, so many unknowns that I was just sitting there, collecting cash, and I didn't actually invest. I started just at the beginning of this year a little bit, and I have another question. Okay, you say maybe the bear market isn't over. Maybe we didn't see the downside at all. What conditions should met for this bear market to come even lower?
So it's not that I'm trying to be contrarian for the sake of being contrarian, right? This is just what markets do when you look at market history. The biggest bear moves happen when there aren't that many bears. Now, there's a reason for that. The reason is because there are fewer people betting on it, right? So when you have so much negativity and you have people conditioned to think that stocks will do nothing but keep going lower, that is the fuel for a melt-up. When you combine that with leading indicators, which it's funny to me, people even today, I have people that were tweeting me about my own research, about my own signals, and saying, "Oh, but look at lumber to gold. It's been pulling back. Doesn't that mean risk off?" It's not. It's like, no, it's not meant to be coincident. It's leading, meaning it moves in advance, right? So I see that more as an anecdotal sign that there's so many people that are still very nervous that the move higher can continue for now, that they're using my own research, which has been largely right, against my conclusions, not actually reading the underlying research. Right? It's the right of the equal sign versus the left. So, and that's why I made that point with a tweet that got quite a bit of attention. I said, it's a melt up. We're in a melt up scenario. And just as everybody believes the bear market's over, that's when the credit event happens, because that's how markets work. They screw everybody. I keep going back to that point. No, really, I keep going back to the point. The stock market humbles everybody, but at different times. Right? And why does it humble everybody, bulls and bears? Because just when you're overconfident, just when the crowd believes with certainty that something is going to continue, is when it reverses. So right now, I still, just anecdotally, forget about even the signals. The signals confirm that the melt-up setup is still here. I still see a lot of people that are fighting the last war. The last war was a declining, continuous stock market, continuous in the sense that you had 59% of the weeks last year, the S&P lost money. I keep going back to this about path, right? So if people are conditioned to be bearish, then that's exactly why stocks probably go higher.
Yeah, contrarian thinking.
Okay, we were going through your social media recently, and you shared a live poll asking followers whether the bear market is over. I believe it's still ongoing. And I was wondering, what was your opinion about it? Yeah, you said something now, so I take it as you believe that there is still a higher chance of the bear market, to go even lower.
Yeah, it's funny, right? Because I put that poll out, and I myself believe the bear market, the lows are not in. But as of right now, right, it's like 70% of the people on that poll are saying, the bear market's not over.
Okay.
So I see 70% of people saying the bear market's not over, and respectfully to the FinTwit community, there are a lot of people on Twitter who really don't understand markets. They don't understand how the economy works. And by the way, that's not to say that I fully understand it, because it's a very complex animal, but I certainly know the amount of time and effort I put into studying this field.
Of course.
Right? Versus people that are tweeting and retweeting and just showing charts. And It's like, it kills me. People show all this data and all these charts, and it's like, I know for a fact all of these data points, like all these likes and retweets, there's zero predictive power in 99% of the things that people put out there. And I know because you can back test it. So people are so focused on showing a bearish chart rather than even learning how to back test if the bearish chart tells you anything about the future. So the fact that there's a large amount, 70% of people, saying the bear market's not over, and I know that the makeup is probably not as thoughtful in terms of the amount of time spent understanding markets and the economy, that tells me that the melt-up probably continues. It's a contrarian indicator when, despite a very sizable move, there's still a lot of conviction. All right, so that's why I go back to this melt-up scenario probably doesn't end until a lot of these bears give up.
Yeah. So based on what you are saying me now, besides all these technical analysis you are conducting or other investment theses, you're also anticipating some kind of behavior of the market and its participants, and what others can also or what indicators can we follow to see and follow this sentiment, and how can we predict that this is time when the contrary action should be put in place?
Okay, so this is, I always go back to every strategy is a function of three things, right? Signal,
Okay.
look back period on the signal, and then opportunity set. Okay, unfortunately, people, they get fixated on just the signal, but the opportunity set is equally as important. How do you execute offense or defense, risk on or risk off, on what opportunity set you're looking at, right? So that's what I was saying. Like last year, the signal was right, being risk off the bulk of the year in the case of lumber to gold, in the case of utilities against equities, leading indicators of volatility, not coincident. But treasuries, the opportunity set, are what failed. If you use utilities, if I had used utilities last year in my funds as the risk off play, and utilities are a risk off sector, my funds would have had a very different return profile, unequivocally, with the exact same timing on the signals. So, but people, I get it. They focus on signals because that's how they're hardwired. They don't think about the interaction against the opportunity set. Okay, now I've done thousands of back tests. I put out research papers that show, these leading indicators of volatility. There's certain things to always keep in mind. Number one is, it is true, there are very, very few true predictors when it comes to investing. Very, very few predictors that are good. That's why the vast majority of people and vast majority of strategies underperform buy and hold, because it's really hard to beat passive. There's a reason for that. There's not that really, the markets are largely efficient. You can argue in the long time frames. In the short term, not so much. Okay, that's sort of tenet number one. The other dynamics of this is that which is predictive tends to tell you the same, or tends to try to tell you the same, gets you the same answer, which is what's happening to the demand for money. What's happening to the demand for money? Okay, so in the case of these 5 research papers that were anonymously submitted, the judges didn't know who I was and who was submitting these papers against a whole bunch of other peers. 2014 Dow Award, 2014 Founders Award, 2015 Founders Award, 2016 Dow Award, 2020 Founders Award from NAME and the CMT Association. The commonality across all the papers in documenting leading indicators of volatility is that the indicators tell you about changes in the demand for money. Utilities are a leading indicator of stock market risk. Why? Because utilities are the most bond-like sector of the stock market. When they outperform, they tend to warn you of tail event risk rising, conditions favoring higher volatility. You go back to the late 1920s, when utilities are outperforming the market on average, stock market volatility is higher. This is fact. It's not based on my opinion. Mm-hmm. You look at lumber to gold. Lumber to gold is about housing, which is about mortgage rates, which is about demand for money. You look at moving averages. Usually when you're below moving average, you're in recession, demand for money. You look at the VIX. Usually when the VIX has spiked, it means demand for money has collapsed, right? It means there's no liquidity, right? So that's what a volatility spike is. So from a contrarian signal, that's also about demand for money. So my point is that, and of course treasuries, which of course are interest rates. So my point is that the only things that I've seen, and I've done a lot of different tests, okay, the only things that really do have predictive power are those areas of the marketplace most sensitive to interest rates. That's why I focus on lumber to gold. That's why I focus on utilities. That's why I focus on the bond market, on credit spreads. This is the stuff that gets you, 50, 60% of the way there. And I say that also because that's the third major tenet, which is that The harsh reality is that not only are there few predictors when it comes to investing and trading, but whatever predictors you have, like in the case of my signals, only explains a portion of why markets do what they do. The rest is randomness. The rest is noise. The rest you can't model. So that's why it's funny to me when people show these like perfect strategies, these like 45-degree lines, and they show these fancy equations with hundreds of variables. It's like, this is a disaster waiting to happen. This is why hedge funds blow up. You cannot create a robust approach to markets if you think you can curve fit by throwing as many variables as possible to get you to what the past looked like, as opposed to saying, let me focus on the area which might explain 50-60% of why markets do what they do and accept the truth, which is that the rest is probably randomness. Rather than, again, trying to over-optimize and chase optimization. So I know it's a long-winded answer, but my whole point with this is that, from a signal perspective, it's ultimately about demand for money. It's about it being a leading indicator, not a coincidence indicator. The sentiment is more anecdotal, but it does seem to line up from a contrarian perspective against the signals that I'm, documented as having predictive power. And I go back to the opportunity set really matters. If you guys, were doing momentum signals on the S&P 500 over the last decade in the US, you did great, right? You did phenomenal, great returns. You take that exact same momentum signal for emerging markets, you get your ass handed to you. It's like death by 1,000 cuts because you get false signals, right? So that's what I'm saying. It's more than just signals. People get obsessed with signals. It's ultimately also about the opportunity set and the cycle favoring your opportunity set.
Yeah, so it's more complex than many people are anticipating. I totally agree. And there is one thing you mentioned, VIX, and I've been actually following VIX for a while, and there wasn't spike like it should be in some kinds of in volatility during the market. And I also think the Michael Berry also mentioned some kind of VIX being heavily short squeezed. What is your opinion on VIX and why we didn't see some big spikes in VIX?
Yeah. So a couple things. So first of all, it relates to the dynamic of last year, right? Which is that the flight to safety trade failing, which I said was my hell, right? Treasury is not benefiting from volatility in equities, is related to the VIX not spiking, which is also related, by the way, to credit spreads. So I keep going back to risk off is ultimately about default risk off. When you have high volatility in equities, this by the way this is kind of a really important point. You often hear that argument that the Fed will raise rates until something breaks, and that the something breaking is the S&P 500, which is why there's a Fed put. It's not true at all. It's not a Fed put on stocks. It's a Fed put on credit spreads, on default risk, because that's what impacts the real economy. So last year was a strange year in that you had a devastating year for bonds. It was really a shift in the entire bond market. You didn't have default risk, right? You didn't have credit spreads stayed tight, right? Which is really bizarre, right? In the way the bond market internally behaved. So as long as credit spreads are tight, you don't have default risk. You're not going to have a VIX spike. So what I'm arguing to you is that it's one and the same. If you were to overlay the VIX against OAS option-adjusted credit spreads, you see a one-for-one relationship, meaning you get a VIX spike in equities, you get credit spreads widening, you get a flight to safety. You didn't have that. So part of that is why you didn't have a VIX spike. I will say something also, though, which is important, because I think it's like I put out that tweet that speaking about contrarianism, the fact that day trading and retail activity, from research I've seen, and CNBC had a segment on it, is at lows, right? People day trade when they're overconfident. When you break overconfidence, that's actually when you have a bullish move. That's another reason why I would argue that the melt up is probably not over. But at some point, you're going to have a VIX spike. And again, I go back to, if I'm right that you have a credit event, I think this year, down the line, not just yet, then you should see that VIX spike. You should see stocks break the lows. You should see the return of the flight to safety trade. You should see the undoing of all of the hell that happened last year. And by the way, selfishly, I'm biased. I want to see that. Because it's like people think that with my rules-based approaches that I'm saying melt up because I'm talking about my own book, because that's how I come back in my funds. It's not true. I actually come back in my funds primarily from getting the risk-off trade right. I want to see the stock market go down hard. At the same time, treasuries counter. remains to be seen. But that's really the sequence that I myself need for my own strategies.
I understand.
Okay, how do you see conditions in the current market favoring an all-weather portfolio like 60-40? Well, should investors return to it, or what is your position?
Yeah, it's okay. So this is actually a really interesting question. So I keep going back to general rule of thumb: you want to buy dislocation, sell normality. Okay, so I mean that's basically buy low, sell high, right? Normality is high, the dislocation is the drawdown, right? Okay, so the fact that everyone says 60-40 is dead probably means it's about to have the greatest comeback since Lazarus. Okay, but just I say kind of as a joke. But but there's a nuance there, which is that the 40 has credit risk. So I go back to, if I'm right that we see with hindsight 2 back-to-back bad bond years. 2022 was a bad bond year because of duration risk. 2023 becomes a bad bond year because of credit risk. Then there's going to be an opportunity for 60-40 to be better timed, right? Because it wouldn't surprise me at all this year if you see junk debt yielding 10-15%, which would be a hell of a buy if it gets to that point, right? Because then the Fed's going to step in. That's your disinflation, deflation shock, and the Fed just repeats the same cycle it always does, which is try to prevent mass bankruptcies by throwing money into the system, right? And by the way, that thinking is not based on some randomness. Again, most bonds with low rates, they mature. A lot of these bonds post-COVID, they mature next year, so they're going to roll over into higher rates. I very much believe the reason Powell's alluded to the idea that he expects inflation will be at 2% next year, which sounds aggressive, is because he knows he has to lower rates in advance of the refinancing rollovers that are going to be happening from all these low rates by a lot of zombie companies into a higher rate environment, and he's got to get ahead of that.
No.
We can criticize the Fed from here until tomorrow. They're not stupid. They may be wrong and late, okay, but they're not stupid, right? There are things you can see coming, right? So, that's what I'm saying. This is going to be a really fascinating period. So going back to the question on 60-40, it's not dead. I mean, it's probably just starting to breathe again, right? It might go back into a coma for a short period of time, but I find it hard to believe that all weather doesn't kind of as an approach work again. Look, I keep going back to this point. Just because it's raining doesn't mean you'll crash. Just because it's sunny doesn't mean you won't. All weather doesn't mean you're guaranteed to keep doing well. It's still about probabilities.
Mm-hmm. Yes. Okay, but so if I'm not mistaken, what you just mentioned is Fed wants to push down the inflation because of the bonds that will mature next year, and will actually Fed manage the soft landing, or did it already?
Yeah, I mean, it's funny because I do a lot of these Twitter spaces with different guests. I had one on earlier, and I was kind of hitting on this question of precision, right? A soft landing assumes there's a degree of precision in what the Federal Reserve is doing in a very complex system, which is very highly levered, where any single butterfly flapping its wings can create a hurricane.
Yeah.
So I find the soft landing narrative a little bit off from that perspective. It's not impossible, right? But a soft landing requires a degree of precision, which I think is hard to get. So to me, it's very simple, right? Either you crash, okay, which is not a soft landing, or you actually never land at all and you keep taking off, right? And this is the other scenario, which is not a very popular opinion because nobody wants to believe it. But I mean, it's like the jobs data in the U.S. Okay, so everyone's saying, oh, that means the Fed has to keep on hiking rates, and that's inflationary. We got to a point where people forgot it's not just inflation, but also real growth. Real, meaning after inflation growth. We could be transitioning from higher inflation to higher real growth. We don't know. In which case, we never land at all. Right? In which case, the bear market is over, and everyone then is back into the cult of equities. Right? My point is, it's not impossible. It's not my base case. But if we go back to it's not about sort of the idea of precision of a soft landing, slowing it down just enough to Goldilocks. I think Goldilocks is less likely than actually either a crash or the other extreme, which is a real hyper growth environment, which again is not a base case, but I think it's more likely than a soft landing.
Okay.
Okay, perfect. So we are currently in the end of the January, and how would you say you would build your portfolio for 2023 and beyond in terms of asset classes, let's say?
I'm a big fan of dartboards. Just, so just throw darts and see what happens. No, okay. And I say that kind of tongue in cheek, but also a little bit serious. And I say that. Why am I saying that serious? Because the reality is nobody ever really knows what's going to work and what's not going to work from a multi-year perspective. Nobody knows, right? You have to ultimately position. That's why I go back to the short term is more observable than the long term, and the long terms are rolling series of short terms. Okay, so let's talk about the rolling series of short terms. Okay, and this has been sort of a bigger theme of mine. So I've got the melt up short term conditions, then the credit crisis, at some point this year, let's call it intermediate, and then long term multi-year cycle, which is emerging markets. Okay, and it's funny because I feel like I have to explicitly outline the time frames because people seemingly on Twitter are they're not able to understand chronology when I talk about this stuff, right? You can be bullish and bearish at the same time. It just depends on your time frame. Okay, so when QE3 came out in September, I think it was September 13 of 2012, when zero interest rate policy took place. When zero interest rate policy took place, what was the effect of all that? The effect of all that was you cut off a lot of the fat tail losses in U.S. equities. So I've shared that chart on Twitter before. It's not my opinion. You look at the monthly distribution of returns for the S&P pre-QE3, from QE3 to last year to now, you didn't have meaningful losses in U.S. equities because the effect of zero interest rate policy QE was that it cut off the left tail. So you were as likely to have large gains as you were large losses, which is not the way markets work. So it resulted in this really unfair advantage for U.S. large caps, whereas emerging markets, international stocks, had the fat left tail in place, meaning you still had larger losses relative to gains overseas, while the U.S. enjoyed this unfair advantage of QE and zero interest rate policy. Okay, well, now you've gotten rid of that. Now the fat left tails are reasserting. So the implication of that, I think, from a multi-year perspective, is that you've leveled the playing field. That now, if you have U.S. stocks and emerging markets both having a fat left tail, the death of QE is the rebirth of emerging markets because they're cheaper on a valuation basis, and you don't have, again, that unfair advantage that zero interest rate policy and QE favored the U.S. Now, that by the way, also has implications on the dollar.
Yeah.
Right? Because to the extent that you had foreign flows into the U.S. because foreign investors saw the unfair advantage of QE and ZIRP and went into large caps, that means that the dollar was also propped up, which is really counter to the narrative that most people have out there. Oh, the Fed did all this money printing and the dollar would keep going lower. The dollar didn't go lower. Why? Despite all this quote-unquote money printing. Because momentum players outside the U.S. went into the U.S., right? So my point is, I do believe we are in this, there's a structural change that's happened. We can debate whether or not QE comes back or not from here to tomorrow, but optically, I find it hard to believe that they do QE when inflation's a lagging indicator, and inflation will take some time to drop. Okay, so I do think emerging markets probably are going to have a multi-year run. Now, you're going to have, in that rolling series of short terms, making up the long term, plenty of periods, like last week or 2 weeks or a week and a half, where emerging markets are weak, and everyone's like, oh, what happened to emerging markets? It's like, guys, I'm not talking about the very short term. Let's not think like amoebas with an attention span that short. Let's think longer term in terms of causation. You level the playing field. From an asset allocation perspective, it's one of the most bombed out, underinvested parts of the marketplace. I get it. Everyone is cynical on the idea of emerging markets because it has not worked for so long. That's probably why it works, because cycles are still a thing.
Nice. Okay, so we will see. And I have another question.
Back in 10 years. You have me back in 10 years, and I'll tell you that I was right.
Of course. I mean, here from our side, we are long-term investors, so I totally agree. Let's meet in 10 years and we will discuss this. But I have another question for you, because I'm following really different people on Twitter and FinTweet, and I like the contrarian views. And there are growing voices supporting the uranium bull case for this year and beyond. What is your take even on uranium, and if you have any at all?
Yeah, I mean, uranium is an interesting play. I mean, I like the the thesis behind it very much. I think it's challenging for a number of reasons to really get sustained momentum. One is you have to have a larger weighting in a portfolio. So this is sort of the tricky thing about things which allow you to differentiate yourself in a big way. If you want big momentum in uranium plays, you have to have advisors, allocators allocate to uranium. So you need momentum for momentum to kick in, is kind of my point. But because you haven't had the momentum from a technical perspective, it's hard to sort of make a case for it until the momentum starts. Okay, so I'm making a very circular argument. My point is, like, you need to have momentum for it to be a self-fulfilling cycle. The fundamental case for uranium, I think, is there. I mean, I've done a lot of spaces with very thoughtful guys who are much more entrenched in that industry than I am, obviously. And it makes sense. And usually I think I'm pretty good at kind of sniffing out, bullshit narratives. The narratives there do make sense to me. But again, it's, you have to be careful being like a uranium maximalist, just like being a maximalist on anything except your own ability to persevere. Right? Yeah. It's like path matters more than prediction. So uranium could, uranium stock, for all we know, could quintuple in the next 10 years. But what if, for the next 4 years, it goes down 50% first? Yeah. Right? Like that's the challenge with this stuff. So it's like everything else. It makes sense to, do an allocation there, probably a small one. As momentum picks up, then you can try and up it and manage the risk around that. But I'm always cautious of sort of, this is the year for uranium, or this is the year for tech, or it's like I don't know, and neither does anybody else. Could be, yeah, but I just don't know.
I like your view that you are not heavily predicting like somebody, like that. Hey, this year is for this year is for this. So I like the view. You should allocate small portion and wait. I like that.
Yeah, and by the way, it's like that's not a controversial position. I keep going back to, like, a lot of people, when I was tweeting nonstop, and I was admittedly annoying as hell when I was doing it. When during the Bitcoin collapse and crypto collapse, and I would take screenshots saying store value when it was down like 10% a day, whatever it was. And people thought I was like being anti-Bitcoin, anti-cryptocurrency. No, I was anti-narratives. Right? There was so much overconfidence in terminology that was nonsensical because there's tail risk, that I was basically just trying to show like these narratives are wrong. But that's not to say that I don't believe one shouldn't have Bitcoin in a portfolio, because the very definition of the market is not the S&P 500. The classical definition of investing in the market is all assets. Now, we can debate the weightings, but investing in all assets means having a portion of Bitcoin.
Okay, but actually, you do you have cryptocurrencies or Bitcoin in your portfolio?
No. In my case, I mean, so I'm an entrepreneur. My capital is tied up in my own funds. That would I consider, at some point, assuming that, I come out of this drawdown and I get sort of my redemption story in the risk on, risk off approach. I have another fund that's, in the queue to be launched, but I'm just waiting for an equity drawdown for that to go live. It's an equity fund. That's why I'm waiting for that drawdown, but I have a fourth fund coming out. Okay. Once that's out and I've kind of built out, that fund family as an entrepreneur, yeah, of course I'd go into it. Why wouldn't I?
Okay, so you are open, but not yet.
It's always about liquidity.
Yeah.
It's always about liquidity, right? It's like, this is the other thing that people, I think, look, you can either be a maximalist on an investment, or you can be a maximalist on yourself. If you're an entrepreneur, you have to be a maximalist on yourself, right? That's where you have to go all in.
Yes.
Right? So I am all in from an entrepreneurial standpoint. And I bust, I work very hard, and I do my best to be open and talk to as many people as I can. And it's exhausting. I travel, and it's a very hard life, the life that I chose. But I wouldn't do that if I didn't believe in it and know the research behind why I'm doing what I'm doing, right? So, it's true. I've used this line before. It was at a conference. Somebody once said that diversification is a luxury for the rich. Diversification is a luxury for the rich. So I will buy Bitcoin when I get to that point.
When I get to that point.
Right. Hopefully when I get to that point, from all the effort paying off with a long lag.
Yeah. Nice.
Okay, and from a short-term perspective, which role is going to is gold going to play in investors' portfolios? Would you say?
I think broadly speaking, part of the argument I just made around the fat left tail, was that all this money all the momentum players went into large caps because of QE3 and ZIRP, zero interest rate policy. You don't have that. The same arguments I'm making around emerging markets would probably benefit commodities, would benefit gold. Again, because now you don't have the unfair advantage of the reduction of the fat left tail. So if I'm right on that, gold probably is also in a multi-year cycle. Now, I keep going back to, I think people get gold wrong. Gold is the ultimate diversifier. It's a hedge against nothing except that it just provides non-correlated returns, right? So I view it more from that standpoint. So to the extent that if I'm right that, and this is more of a multi-year argument, if I'm right that we're in a lost decade for U.S. stocks, which, by the way, we went through a lost decade in emerging market stocks, we went through a lost decade in commodities, we went through a lost decade in bonds with the bond sell-off last year. If I'm right, we're in a lost decade for U.S. stocks, then gold should get some relative strength because gold, as a diversifier, would be more in demand by advisors simply trying to be different than beta, U.S. beta, right? So I do think that move is probably there, but it's like everything else. It's always about sizing. Gold, as you know, the problem with gold is that there's no yield. Isn't it funny that for the last decade, the argument that gold bugs had was that gold has a higher yield, real yield, than bonds.
Yeah. Okay.
And yet now, when you have positive real yields, gold is doing well.
Yeah. For my bond is like gold is, like you have it physical gold in your treasure in your safe, and you just wait when the times are bad. There is no money around. Gold will always help you. And this is how I'm personally looking into gold and allocation funds to the gold.
Yeah, although I'll tell you something though, it's I always think of that as being an inconsistent argument. It's like people say, well, gold, works if it's an end of the world situation. It's like if you're betting on the end of the world with gold, you better learn how to farm.
Yeah.
Right. It's like, you know what I'm saying? Like, it's like, no, really, it's like if you're, people use that as an argument to buy gold. It's like, no. The ultimate currency is skill, is survival, right? It's not a yellow metal, right? So it's like, I'm not saying, I'm just kind of pointing fun again at the narratives, right? But again, I go back to diversifier. So what is the definition of the market? Owning everything.
I like this. Okay, and how about silver? What is your opinion on silver, and how the silver is different from gold?
Yeah, I mean, as you know, right, silver is more of a sort of industrial play. Some people use it as a leading indicator. I haven't really found too much that would indicate it's a leading indicator, but that can be debated a bit. Look, these things tend to co-move, right? So there's a reason why silver is called, the poor man's gold, right? Because it tends to co-move just with a cheaper per ounce price. But yeah, I think that again, there's the argument for owning everything as the definition of the market and then tactically trading around it. I have no opinion on tactically trading silver now at this point. To me, it's more just something that's worth paying attention to, because when nobody else pays attention to something, tends to be when you have the biggest payouts.
Okay, perfect. Then the answer probably depends on the answer for this question. Probably depends on I'm sorry, whether you are a long or short-term investor. But is technical analysis enough to be a successful or profitable trader investor?
No, sorry, it's just not, and it's because it doesn't tell you anything about weighting. It doesn't tell you anything about how much. I keep going back to that point. It's like, it's not about what you own; it's about how much you own of it. Right. This is what kills me about FinTwit. People show all these charts and all these, squiggly lines and all this, and nobody ever talks about how much they own of whatever they're showing.
Yeah.
It's like, wait, I don't care that you got a trade right that you put 1% of your portfolio in. That's not impressive to me. Right. Where the other 99%, are something that broke support that, was the reason why you bought that 1% stock. It's nonsense. Look, at the end of the day, I keep going back to, while it's good to be aware of things, portfolio management is more than just a chart. It's about cycles. It's about opportunity set. It's about the interaction of asset classes to each other. It's about spillover and lagged effects. It's about back testing. It's about strategy development. It's more than just what you see on FinTwit. And that's why FinTwit, I keep going back to, is like the modern odd lot indicator, because people don't know what they don't know. And they keep regurgitating the same stuff that confirms their existing views. They keep looking to the right of the equal sign, when if you really want to understand something and get good at anything, you have to go to the source. You have to put the time.
I like this. FinTwit is modern outliner indicator. I like this idea. I will write it down.
And what are maybe your suggestions for people who want to be like you, like a portfolio manager, have or lead their own interviews and own ETFs, funds?
I would say don't be like me. Well, and I do have to hop for another call coming up here. But okay, first of all, it's I think it's a mistake to say you want to be like someone when it comes to investing. Like people that say they want to be like Buffett or they want to be like Stanley Druckenmiller.
Yeah.
Everybody's a unique animal. Everybody has a unique set of personality traits, has a unique way of perceiving risk. You can't be like somebody unless you have the exact same gene makeup, unless you have the exact same risk tolerance, unless you have the exact same amygdala in terms and response to fear, right? Even biologically.
Yes.
So I'm not trying to be evasive on the question. It's ultimately about, you need to learn as much as you can, you need to read as much as you can, you need to soak in as much as you can, you need to not insult others that disagree with your viewpoint.
Mm-hmm.
You need to always, it's true. It's like I know a lot of people are not fans of Jordan Peterson, and a lot of people are. But there is something that he said, which I do agree with, which is that always assume the person you're talking to knows something that you don't.
That's a good one. Yeah,
that's a good one.
No, really, and I'm saying that's like a life lesson, right? That I very much believe, right? And unfortunately, you see a lot of people that don't have that mindset, right? So it's not about trying to be like me or think like me. It's about trying to find what works best for you. But in order to know what works best for you, you have to have the right foundation. And the only way you get the right foundation is the way you get the right foundation with any endeavor you want to be successful at. You put the hours in, put the time in, and you don't just do, drawings on a chart and to make believe that you know what comes tomorrow.
Okay. And I think this is the lesson we are leaving it today. Michael, we sincerely thank you on behalf of our Investors Club for this valuable interview and for your insights. And I would love to also say thanks to our listeners that listened to this part and staying with us to the end. Michael, thank you again.
Yeah, no, I appreciate it. And those on Twitter Space, given that I was streaming this while we're doing this podcast live, I appreciate you guys.
Thank you guys that you are listening to us on Twitter Space.
And to our fellow listeners, do not forget to follow us on other social media, such as Instagram, LinkedIn, or Facebook, to see our upcoming events or workshops. And if you enjoyed the episode as much as we did, please do not forget to rate it. And if you have any suggestions of who our next guest should be, write us an email to podcast@klubinvestoru.com. You can find it in the description. Thank you once again and have a good day.
Thanks. Have a good day.
Thank you, guys.
Thank you very much, Michael.